very good evening, everyone. Thank you for joining us for our webinar tonight. So today we will be talking about the Hong Kong financial sector. So we have our analyst from Hong Kong, Michael. So after I do a brief introduction on some of the campaigns that we have running, I'll pass the time to him. This is basically I think this is our fourth webinar for Hong Kong market. We've been doing a series of it for a while now. So I'm glad I'm glad there are more people joining us. So we have participants from Malaysia, Singapore, Indonesia, and Thailand. So welcome. All right, we have a campaign running in Malaysia at the moment for cross-border trade, specifically for Hong Kong and US market. So this campaign is only available for Malaysian clients. So I think there will be another campaign that's running off probably for the rest of the market soon. So you probably want to check with your respective sales team. Anyway, this campaign is the CGS Buddy Go Global campaign. So basically it's about refer and earn. So whenever you invite your friend to join us and trade with us, you will actually earn 100 ringgit cash bonus, and you can earn up to 5,000 ringgit with multiple referrals, right? So I think there will also be a grand prize at the end of it for those who want to win an Apple shares. So that's quite a bit of stuff that we have offered for you guys, but it's a limited time campaign and it's only for cross-border trade in both Hong Kong and US for our Malaysian clients. All right, let me just do a brief introduction for those of you who do not know Michael. I think Michael is our head of financial sectors in Hong Kong and China. So he has over 17 years of experience. I think he's in both sell-side career as well as within the in various global investment banks as well. So he's also a CFA qualified, and I think he also has a double degree Bachelor of Commerce and Bachelor of Law from the University of Sydney. So very, very technical, very, very academic people. So I'm just going to pass the time to Michael so that I don't take too much of the time. Michael, over to you.
Thanks, Billy, for the introduction. So as Billy said, I've done the rounds. I've been in this firm for the last 10 years. Currently, I have the Asian financials team, but I do have primary coverage for the China banks, the China insurers, as well as the regional insurers, AIA, Prudential, and together with my team member, we cover Hong Kong Exchange as well. So today we'll talk about talks much more on the China banks as well as the insurance space. Within the pecking order, I do have overweights on all of them, but the top pick actually is Prudential and AIA, followed by the China insurers of which it's Ping An, China Pacific, and then China Life, and then after that will be the China banks, which I still have an overweight on, but on a relative point of view, I'm not as bullish. But in terms of the upside for the China banks, I still think that despite their strong share price performance over the last 1.5 years, they can still continue to rally. So let's start off with the banking sector first, because I think that's more widely held among across the region compared to the insurance space. So I'm going to share some slides. Let me see. I'm starting off with. So in this slide over here, this is essentially the banks that we cover. You can see on the top of the table are the H shares, the bottom are the A shares. We definitely have a preference much more towards the H shares, those listed in Hong Kong compared to the mainland. And that's reflected in the number of the ad calls that we have. In terms of our pecking order among the banks, we like CMB, that's China Merchants Bank, followed by CCB, China Construction Bank, and then ICBC. In terms of the reasons why, it really revolves around track record for China Merchants Bank, in terms of the quality of management, plus the very strong share price track record across time, which typically sees it outperforming the other banks. Second pick will be CCB, and that's also large. And CCB and ICBC, number 2 and 3, is largely due to cheap valuations and relatively more attractive dividend yields. And this actually is highly relevant to the class of investors that have been driving the share price up for these China banks. And these investors specifically are the southbound investors under the Stock Connect programs. So let's place things in context. How much money have China bank investors made over the last 1-2 years? You can see on the bottom left over here. So I'm going to expand the screen. The slide over here, specifically the column, the third column, MSCI China banks. And you can see over here, last year up 34%. 2025 year to date, I think this is as of the end of July, it's up 24%. So, pretty impressive. And relative to the rest of the China index, you can see on the right-hand side over here that, the performance actually has been outperforming in 2021, outperforming in 2022, 23, 24, and 2025 just slightly outperforming. So all in all, fairly good performance. And then the question investors typically ask, what's driving this? How sustainable is this? So in essence, it's an overweight position. It's really, well, I've got a lot of factors over here. It's really the highly defensive qualities, the high dividend yields makes it very attractive to the southbound investor. And the southbound investor, I'm going to show over here on the right-hand side. You can see on the right-hand side chart over here that the mix of the southbound investors rose significantly from June of 2023 all the way up to right now. And June of 2023, they basically had 13% of the China Bank H shares in Hong Kong. And on the right-hand side, now that's gone over 25%. So the key question then is, what exactly caused things to change in June of 2023, where you can see that inflection point? Essentially, so that's your southbound investor chart. Essentially, what caused it to change is really the insurers in China who are looking to actually invest offshore. I'm showing you a chart over here. You can see on the bottom right, okay, the bottom right, what happened in 2023 when China ended COVID-0. And unlike the rest of the world, which saw inflation problem, which saw a pickup in economic growth, China went the other way. And when China went the other way, bond yields started to fall. And when bond yields started to fall, you can see in June of 2023, bond yields said that the 10-year bond yields went from 2.64 down to July of this year, 1.64. So when you started to have that, the life insurers who tend to invest in long duration bonds, they had a choice. They said, do we accept the lower bond yields and hence have lower investment returns, or do we try to find substitutes? Because back then, the China banks had very high dividend yields. So back then, the China banks' dividend yields on the top left over there was 10%. But after the very strong performance over the last 18 months, that's come down to 5.5. Now, 5.5, is that attractive still for the insurers? And the answer will be yes. The answer is yes, because it's all relative. It's not the absolute level that matters. It's the relative level. So from the bank's point of view, from the life insurer's point of view, if you're trying to determine whether the bank's dividend yield of 5.5% is attractive, you need to look at it relative to the government bond yields. And you can see where we are right now. The spread over the government bond yield, the dividend yield spread of the banks over the China's government bond yield, it's fallen down to 4.1%, but it's still above the long-term average of 3.4. And to get down to the long-term average, your China banks' share prices will need to rise by roughly another 20 to 25%. So all in all, talking to the banks in mainland China are telling me that they're meeting insurers more and more. The insurers actually do want to have meetings with these banks to understand them better, because they do plan to invest more in banks. And secondly, those that are who can invest offshore in Hong Kong, they're choosing to invest in Hong Kong more than mainland China, because in Hong Kong, one, due to valuation gaps whereby the Hong Kong listed China banks, like ICBC, is trading at a 20 to 30% discount compared to the mainland China listed ICBC. Hence, they can get a higher dividend yield by investing in Hong Kong. So you're seeing a foreign market flows into Hong Kong that I believe can sustain because of these still attractive dividend yield spreads. So that's from a flow point of view, and that really matters, because the thing is that, in terms of the flows, one of the things that we have seen this year is Ping An, the number 2 insurance company in mainland China. They've been erasing the stakes in the China banks in Hong Kong, and you can see in this chart over here, if it's shaded over here, it reflects increase in their stake in these banks. And every 1 percentage point increase in the shareholding has to be declared to the Hong Kong Exchange. And just this year alone, they have filed 34 substantial shareholding stake increases. So, you can get a sense they're very aggressively expanding offshore. It makes a big difference, because in this slide over here, on the left side, I quantify that basically, if you strip out Ping An, the second biggest life insurance company, the southbound investor flows into the China banks is at a net level 0. So it's really the life insurers that have been driving the share price, and Ping An has been one of the key drivers. But it's not just Ping An, because the fact is that the analysis that I've been doing indicates that other insurers are also doing the same thing, investing much more into Hong Kong compared to mainland due to the dividends. So that actually has been a much more important driver for these share prices of the China banks than anything to do with earnings, interest rates, or the economy. And I would actually say, given my regional experience, if you're worried about the earnings of the China banks, you don't really have to be, because in China, unlike any other market that I've covered, the earnings tend to be very easy and very stable to forecast. What I mean by that is, in no other market have I seen this relationship whereby there is a over 90% relationship between the nominal GDP of the country, or in this case China, and the net profit growth of the China banks, like by 1/4. And that basically means that unless you expect GDP in China to plunge significantly, and China is all about stability, so typically they don't really see recession, so you don't see GDP being as volatile compared to other countries. Unless that happens, your profit growth will essentially be quite stable, and from that point of view, your dividend flow will be quite stable. So, the big picture, what I'm trying to actually say is that I do believe that China banks, you should see it as a quasi-fixed income in the same way that the life insurers have seen it as a quasi-fixed income. And this is important because with a lot of the global investors having minimal holdings, especially in US, Europe, having minimal holdings in the China banks, what then drives the share price are the southbound investors, the mainland Chinese insurers. And that's the whole reason why, despite investors' so-called concerns about the economy, that's the whole reason why these China banks have actually outperformed the MSCI China index for the last 5 years and have risen by more than 50% over the last 18 months. So that's the China banks in a nutshell. I'm going to, let's see if there's any questions. Okay, all right. I'm going to go on to the the insurers, okay, first, because there's the AIA and there's AIA Prudential, and there's also the domestic China insurers, which have done quite well. Now, sharing the screen over here. Okay, so let's frame the picture for the insurers. All right, so also quite attractive. Now, on the left side, you've got the share price performance of the China insurers. You can see in terms of the last 1 year, which I'm highlighting over here, not too bad. China Life is up 81%, Ping An's up 64%, NCI over here 218%. And for the insurers that we do like as our top picks, you might think, oh, it looks very boring at only 33 to 36%. But if you take a look on the right-hand side chart, or if you just take a look at the last 6 months, for example, Prudential is up 72% over here. That's Pru. And then on the third column from the right, AIA is up 34% in the last 3 months. So these stocks are starting to rally, and I think that rally can actually continue. So what's driving it then? What's driving it? Now in the case of AIA, this is AIA and Prudential. I would say there's a number of reasons. I'll focus on 3 of them. In the case of, let's start with AIA because I think that's more widely held in Asia compared to Prudential. In the case of AIA, there's 3 main reasons I would say. I'll start off with the simple one. Simple one is that, if you think there's going to be US dollar weakness and you think this is a new norm, then which companies do you want to be owning that can actually benefit from that? And over here on this chart, I take a look at the Bloomberg Asian Dollar Index, and I take a look at the share prices of AIA and Prudential. Correlation is very high. Correlation with AIA and the Asia Bloomberg Asian Dollar Index, 80%, with Prudential is 87%, meaning that if the Asian currencies, the Thai baht, Malaysian ringgit, Sing dollar, they appreciate against the US dollar, generally speaking, AIA and Prudential share price will go up as well. And there's a logical reason for that, and that's because they are pan-Asian. They actually have a lot of operations in Singapore, Malaysia, Thailand, Indonesia, mainland China, and so on. So operationally, they do benefit because they report in US dollars and the listed share prices in Hong Kong dollars. So that's one. Secondly, in the case of AIA, I think one key interesting point is there's going to be a chairman coming in who used to be the CEO of AIA, and this guy is called Mark Tucker. He's currently the chairman of HSBC. Now, this guy, he's not passive. He's aggressive in terms of personality. He's chairman at HSBC for the last 7 years. They've had 4 CEOs. Nobody believes he's going to come back to AIA to retire. They do believe he's going to come back to make a difference. Now, the question then is, if he's coming to make a difference, what are the easy things to do? What are the things that can make a difference to the share price? And from that point of view, I think the easy one is, AIA, widely held by international investors. What do international investors value? They value transparency. They value confidence in targets. And over here in this chart, you can see that AIA at the bottom of this chart has only got 4 targets. Only 4 targets over here. Now, if I take a look at the competitors in Asia, whether it's Prudential over here, that's about 10 targets, or Manulife over here, that's about 10 targets. Surely AIA can actually increase the number of targets. And the thing is that, that's not an unreasonable expectation, because the fact is that, HSBC, where Mark Tucker is currently the chairman, he only moves across to AIA from October onwards. HSBC, Standard Chartered in Hong Kong, they value or they give out a lot of targets as well. So I think that's an easy win. Now the thing is that Mark Tucker, when he was CEO at AIA from 2010 to 2016, just to give you an idea of his track record, you can see on the bottom right over here that in terms of the share price performance, AIA had a very strong share price performance from 2010 to 2017. I think if you were to take a look at the areas that are not shaded, typically it means that they've performed better than the market index. In this case, the market index is the HSI, the Hang Seng Index, or the MSCI Asia Japan, or MSCI EM, MSCI World. You can see the only year whereby they had a negative, meaning an underperformance, was 2016. So the guy's got a very good track record. The guy actually knows how to run an insurance company, and this I think can make a difference to AIA when Mark Tucker becomes the new chairman. Secondly, if I go back to that share price chart, now taking a look at AI across the years, ever since its IPO, against the HSI, just expanding the table, you can see the worst year was 2024. 2024, what happened that year? Against the Hang Seng Index, they had a 33 percentage points underperformance, by far the worst year ever since the IPO. The only other year that came close was 2017 at a -7 percentage point underperformance. So 33 percentage points versus -7, massive difference. Questions that investors always ask me then, what drove that? Was that an anomaly, or is that the new norm? And what drove that was really the fact that back in 2024, a major shareholder had been selling down. And this major shareholder was a very big institutional investor by the name of Capital Group. So what happened, this Capital Group on the top right over here had been a substantial shareholder, a major shareholder since 2012. And then you can see all the way to 2024, early 2024, still a major shareholder. But from January 2024, they started to sell down very aggressively. You can see in January 2024, 8%, sold down to below 7%, below 8% in March, sold down to below 7% in April, sold down to below 6% in August, sold down to below 5% in October. When that happened, investors were actually asking me, when is Capital going to sell out? When is it going to stop being a drag on this share price? And what does Capital, this major shareholder, this long-time shareholder, what does Capital know that we don't? So people started to panic. And from that point of view, when that happened, no surprise then, share price was extremely weak. Now, what's changed is that the shareholdings bottomed in the first quarter of this year. You can see that coincidentally, as it bottomed and it started to buy in, and then in July, it started to rise above 5% again. That's specifically over the last 3-4 months. No surprise then that if you take a look at the last 3 to 4 months for AIA, which is over here, the last 3 or 4 months, it was up 34%. And that's basically the bulk of the driver of the share price performance. So if the major shareholder is now interested in the company again, then surely all that concern from investors that this major shareholder is going to sell out, and which drove the 33 percentage points record high underperformance in 2024, surely that will reverse. So from that point of view, that means that there's actually still a lot of upside potential for AIA to actually continue reversing, because the fact is that even though AIA has actually done quite well over the last 3 to 4 months, from a valuation chart point of view, this is only a small bounce. So whether you look at the top left chart, price to EV, or the top right chart, PE, the 30% rally still puts you at, -1 standard deviation below the historical mean. In other words, it still looks cheap. So that's, I think, in simple terms, AIA. Prudential is a story about capital management. Prudential is because, which is another of our top picks. Prudential over here on the bottom left had come out and actually said that it expects a lot of cash to come through over the next few years. And specifically, it's currently at an inflection point for this item called OFSG, which is operating free surplus generation. So basically, it just means it's generating more cash. Over the next 3 years, it's a 19% CAGR for the cash that it generates. Over the last 2 years, it was flat. Now, when that happens, investors are actually saying, okay, if that's the case, we can expect more dividends. And that's essentially what consensus, what the investor community or what the analyst community is also saying as well. Because on the top right over here, over the next 3 years, Prudential's sell-side analysts on average is forecasting a 21% CAGR of dividend per share. So that's highly attractive, the amount of cash you're generating, which we believe helps the share price. The other thing that actually helps as well is that Prudential actually is listing its Indian asset management division, and by selling down part of its stake, it's realizing just over $1 billion US in terms of proceeds, which it has committed to return back to shareholders. So again, that's another nice tailwind to have for Prudential shareholders. And these two events, I would actually say, has helped drive the share price up by about 70% over the last 6-7 months. Okay, so Prudential, like I said earlier on, also a beneficiary of US dollar weakness. Now let's go on to the China insurers, because the China insurers over here, okay, I'll probably spend about 5 minutes and then let's go on to Q&A. China insurers have actually gone up a lot. And like I said earlier on, if you take a look at the last 1 year, China Life is up 81%, Prudential, Ping An's up 64%. Some of them are up above 100%. How then do the valuations look? And in terms of the valuations, where we stand right now, we're still quite cheap compared to history, because these insurers have actually derated a lot over the last 10 years. So you had a bit of a bounce recently, and just to bring up the valuation charts over here, you can still see that. Oh yeah, you can see that in terms of valuation, after pretty you can say it's about a 14-year G-rating cycle, we've had a bit of a bounce. And from that point of view, it's still cheap. Now, if you ask me, do I prefer AIA or AIA Prudential or the China insurers? I would actually say I would have AIA and the China and Prudential above the China insurers, because the thing is that normally speaking, when you see such a multi-year derating cycle, investors tend to get a bit nervous. And even though you can say that it's rebounded, in part because of cheap valuations, in part because the China share market has stabilized, the economy has stabilized, I think investors are still a bit concerned about the long-term sustainability, given the economic challenges in relation to the property market cycle and in relation to bond yields. And the thing about these China insurers is that while in the near term, is in the next 6 months, you have any improvement in terms of growth of premiums, in growth of what they call new business value, which is a key metric for these insurers, there's concerns about long-term sustainability. So I think I see it as more a long-term trade, more than a stock that you can buy and sleep well for the next 5 years. I see AIA and Prudential as stocks that you can buy and sleep well for the next 5 years. But for the China insurers, it's more like you buy and then you might need to monitor it more actively, and might be more like a 1 year play instead of like a 5-year play. So, but within the space, we do prefer Ping An, CPIC, and China Life. So I think I've talked about for a bit longer than I had originally projected. It's roughly about 25 minutes. I noticed that there's some questions in the chat box. Let me just answer them first. Okay, so in terms of do I think that the China banks are a sustainable investment given China's GDP and population growth are decreasing? So on the sustainability issue, let me just pluck out the slide of the banks. I think if you define sustainability as the next 3 to 5 years, I feel quite comfortable about it. If you're talking about sustainability as a 10-year business model, I would say no. Now, why do I think over the next 5 years is fine? I think, firstly, on the profit front, okay, as I said earlier on, in the near term meaning the next 1 year, I still expect this relationship to hold, the relationship between nominal GDP and net profit. And that's in part because of a few things. Firstly, in terms of the buffers that they can actually deliver to actually ensure stable net profit growth. If we take a look at the top line first, or take a look at the pre-provisioning operating profit line, which includes things like loans, net interest margins, fee income, it's starting to show some signs of stabilizing. It's still slightly negative. You can see on the top left over here that the most recent quarter in the first quarter of this year was down -3%, but it's better than historically we're down mid-high single digits. So it's starting to show signs of stabilization, and that's in large part because the net interest margins are stabilizing because of the deposit rate cuts that have happened. Now, specifically, how does it impact the net interest margin? It impacts it because about 60 to 70% of deposits in mainland China are time deposits. And when these time deposits mature, they reflect the combined rate cuts over the last 2 to 3 years, meaning that your funding costs of these banks fall by much more than your loan yields, and consequently your net interest margins improve. So your top line is starting to show signs of stabilizing. Your bottom line actually has got the benefit of banks which have built up very healthy provisioning buffers and NPL recognition buffers. According to my numbers, even with some top line pressure and GDP pressure and asset quality pressure, they can release these buffers such that even by 2027, you can see over here on the bottom left chart, the release of those buffers only sees those buffer levels return back to mid-cycle levels, which is 2018, 2019. We're still above the 2016, 2015 lows. So obviously the peak was back in 2022, and since then we've been drawing down those buffers. So that should help ensure profit sustainability. The other thing, from a dividend point of view, do we think that the dividends can be maintained? Then over here, the key message of this slide is that we don't think there's any threat to the payout ratios. You can see on the right-hand side chart that the payout ratios ever since 2015 15 have been pretty stable at the 30% level for the larger banks. Could be a bit more of an issue for the smaller banks, but I think most non-mainland China investors typically only invest in the larger banks. So from a payout ratio point of view, 30% ratio seems to be the floor, and these banks are slightly above that. From a dividend per share, historically, you can see over here on the top left, they haven't really cut the DPS. Going forward, that could change for some of them, like Bank of Communication, BOCOM. But for the larger ones, or for CMB, I don't really expect a cut at all. And for the banks like Bank of Communications or ABC or even Bank of China, BOC, there could be a slight cut because the capital raising that they did late last year, in the middle of this year, you could have some dilution effects, but it'll be a slight cut. If anything, it'll be a cut by maybe one or 2 cents. So your dividend yield is still quite high. Now, in terms of payout ratio over here, you can actually see in this chart that China's payout ratio of about 30% actually is quite low. The global average is 42%. I think some banks in Singapore have about 60%. DBS, clearly stands out on that front. So I'm not really that concerned about the sustainability if you're talking about the next, say, 5 years or so. Longer term demographics obviously will drag on GDP growth. But I would actually say most investors don't have more than a 10-year investment horizon. Over the next 5 years, I'll be quite surprised if the real GDP number goes below, say, 3.5%. And under a situation of growth of at least 3.5% real GDP, I don't think there's any threat to the profit growth or the dividends of these China banks. Okay, China reinsurance. Okay, we don't officially cover it. We don't cover it. The thing with the reinsurance space is on the P&C insurance front, the natural disasters over the last few years, I think, have been picking up. Last year actually was, the trend at least has been picking up. Last year was actually a fairly good year. This year, I think you can actually see in southern China or in Hong Kong, for example, we've had unprecedented, I think, 3 to 4 black rainstorm warnings over the last 1 month. So we haven't really had that situation before. This is going to flow through in terms of the reinsurance costs for this particular year compared to last year. The other thing about the life insurance front is there's a bit of a tick up in medical claims, especially in relation to critical illness. And at least the global guys like Hanover Re and Swiss Re, they are pulling back in terms of the reinsurance. So while I'm not going to commit on any target price or official recommendation, I actually would say that the outlook for this year looks to be more challenging than last year from a general point of view. So in terms of the next question, all insurance firms.
Michael?
Sorry. Yes.
I think you probably want to look at the Q&A question first as well, because I think they have about 12 questions or so on that front.
Okay.
Do you need me to or you can do it?
I am trying to. Okay, so I'm going through the Q&A in the chat box. You're saying, is it? In the chat box, I can see only 2 questions.
Yeah, but the Q&A got Q&A got a lot more. So
okay, I see. All right. Okay, so in terms of why the rally starts now, okay, 9:19. So I assume this relates to the China banks. That's primarily because the rally actually started in actually middle of 2023, and that's really because of the southbound investors. So you can see on the top right of chart over here, the southbound investors, their holdings of the H-share banks went from 12.9% up to 25%. And the reason why they have chosen to invest much more in the H-share banks is really because the bond yields in mainland China fell. So from that point of view, they see high dividend yield stocks, especially the banks, as a fixed income substitute. And they actually tell me when I talk to them, they have confidence in buying banks compared to other high dividend yield stocks, because the banks are owned by the government. The government sees these banks as important revenue sources for dividends, and hence, they won't really allow much volatility in terms of profits and or dividends. So from their point of view, the rally essentially started over the last 2 years. Prior to that, these China banks haven't really been performing. In terms of the next one, if the banks have been outperforming for a while now, is there risk of overexposure in the bank stocks, especially by the southbound investors? Actually, I would say no, because the thing is that when I have a chat to Ping An, who is by far the biggest or the most active investor in the China banks, and by that I mean that they've not only been the most active in terms of filing substantial shareholder notices, in terms of increases in their stake, but in terms of my calculations, they've actually been holding. Let's see, do I have it over here? Okay, you can see over here on page 10. In terms of the listed equity portfolio, so they don't only invest in listed equities, they invest in mutual funds and other things. That comprises 92% of the portfolio. So they're extremely heavy into banks. But the other insurers that I talked to, China Life, New China Life, and the rest, they are just starting to ramp up their exposure into banks. So I do get a sense that while you can say that Ping An actually is very heavy into the banks, the others are not, and there's still upside from that point of view. In terms of Ping An, is Ping An overly exposed? Ping An actually makes the point that for listed equities, it goes much more into old economy stocks like banks. But for the mutual funds, it goes much more heavily into new economy stocks. And the reason for this distinction is because they say on the mainland, the mutual funds, there aren't that many mutual funds launched which target old economy. There's a lot of new economy focus or healthcare focus or biotech focused mutual fund theme stocks, but not old economy. So that's why they had to invest much more directly via listed equities into old economy like banks. Foreign investors, okay, so the next one, what about foreign investors? Are they coming back to the Hong Kong financial sector? I get a sense that they're nibbling, meaning that, when I went to see them in November of last year, they expressed frustration. They said, Michael, I don't really understand these China banks. Why are they outperforming so strongly? Because they tell me that typically for banks globally, if the economy is weak, if the central bank is cutting rates and net interest margins are falling, and there's asset quality concerns, typically banks are a sell. But these China banks have been rising. So from their point of view, then they started to realize that it's not them driving the share price because they were heavily underweight. It's southbound investors. And from that point of view, a number of them have actually started to buy back into the sector. Having said that, I would actually say that they're still quite heavily underweight. Not as much as before, but still quite heavily underweight. And the reason why they haven't been buying more actively is because, frankly speaking, the rest of the world is still in a bull market. If you take a look at India, for example, Indian financials are performing quite well. So even though they might not have much China financials That's primarily because on a relative point of view, they don't really feel the pain of actually being underweight the China banks. But from their point of view, they see the China banks as, more defensive. They don't have to worry about expensive valuations, unlike the Indian financials. In terms of the China banks and insurance valuations doing in comparison with the other markets, actually from that point of view, doing quite well actually, because if you take a look at the bottom left chart over here, you can see that this year the MSCI China banks is up 24%. Last year was up 37%. And if you take a look at, say, India last year was up 14. India, the entire market, that is. And India entire market this year is up 5. Brazil is down last year. This year is up 19. But Asia ex Japan 10 and 17, EM 5 and 17. So generally speaking, the China banks have actually been outperforming. Same as the China insurers, this year's up 25, and last year's up 37. Again, better than other markets. For what it's worth, over the last few weeks, I've been having more conference calls with the European and the US-based investors, and there has been some buying into some of these names. Yeah, so like I said, they are nibbling, they are decreasing the underweight positions, but they're still quite heavily underweight. Next question is there a concern on how tariffs would affect the overall economy, which would then affect the financial sector? I would say yes, this has been a concern for quite some time. In fact, in 2018, you can see over in this table over here, unlike 2017, whereby the MSCI China Banks Index went up 21%, the MSCI China Banks Index fell 10% in 2018 because of the tariffs concern when Donald Trump first came into power. But later on, they realized in 2019, with the China Banks Index going up 7%, that hang on a minute, it's not that bad after all. And at this stage, I think the investors I talk to who do own China banks, they do believe that the China companies are managing to get the way around it. So essentially exporting into other markets, and you can see that they've been growing quite aggressively exports wise into other markets. And the other thing is that in terms of the large listed banks, just bear in mind that their exposures tend to be large companies, not so much SMEs. So from that point of view, it's more the SME exporters, those that who may not have strong financials, that could be worse hit. The larger banks typically, I don't think, have that much exposure, relatively speaking. Next question, as the US dollar weakens, is the Hong Kong dollar expected to slide too, as compared to the MYR? Unfortunately, the answer to this is yes, and that's because of the peg. So the US dollar and the Hong Kong dollar is pegged between a very fixed range of 7.75 to 7.85. Right now, the Hong Kong dollar is at the weak end of the peg, 7.85. So if the US dollar weakens, the Hong Kong dollar is forced to weaken at the same rate. There is some, potential for the Hong Kong dollar to strengthen to the strong end of the band. So from 7.85 going up to 7.75, but not much more than that. So, from that point of view, yes, if you are bullish on the ringgit versus the US dollar, you should theoretically be bullish on the ringgit against the Hong Kong dollar as well. Why do I have a reduced rating on Bank of Communications? So just now when I was talking about dividends, and a belief that the dividend per share can remain relatively stable, this does not apply to Bank of Communications, because in terms of capital injections earlier this year, Bank of Communications and another bank that I do not cover, which is Postal Bank, actually received relatively large capital injections compared to their own capital base. And the consequence of that is when you inject a bit more capital relative to your own capital base, your dilution becomes more. And the dilution adversely impacts your dividend per share. So consequently, I'm concerned that the dividend per share for Bank of Communications could be more adversely impacted compared to the larger banks that are like ICBC, CCB, or even CMB. So that's primarily why I have Bank of Communications on a reduce. I think the other thing to note as well for Bank of Communications is that relative to the larger banks, its provisioning coverage ratios tend to be a bit weaker. So consequently, if you're talking about weathering a storm, whether it be an asset quality storm or dividend storm, Bank of Communications is not as well positioned compared to the banks. I noticed, okay, the next question, I noticed some of the Chinese banks show negative profitability. What are the reasons for these poor performances, and are they sustainable in the long run, and how? Now, unfortunately, China is political, and by that I mean that outcomes that they deliver are politically influenced. This has got a impact on the profit that they report. So you can see over here, as I said earlier on, in no other market do I see such a high correlation between nominal GDP and net profit growth. While the plus side is that it's easily predictable, the issue then becomes in terms of profits. Could banks then report negative profit growth because of political pressure? Now, what I actually want to show over here on the top left is the profit growth of the banks in mainland China, because now the economy is weak and because the banks don't really want to actually be forced to do a lot of national service, cut rates, cut fees, and hurt their profitability. The banks are actually saying, well, why not we report negative profit growth for a few quarters, and then maybe at the full year we break even. So that's essentially what happened in 1Q of 2024. You can see over here, sector weighted average was minus 2.2%. And then 2Q, 3Q, 4Q turned positive, such that the full year FY24 ended up at plus 1.5%, even though the first quarter was negative. Same pattern is repeating this year. They are reporting negative 1.9% as a signal that, hey, our net interest margins are record lows, our profitability is weak, don't force us to do too much national service. And I think if you take a look at the loan growth numbers, the banks are pulling back in terms of loans as well, because they don't really want to be forced to lend to corporates who they think could actually be relatively weaker in terms of asset quality. So unfortunately, this negative profitability thing, I think, is a political signaling tool. My base case is that like last year, they start off negative in the early quarters, and then they end the full year at slightly positive. And I think that's also maybe because the Ministry of Finance, they want to have stable centric or stable to a slight increase in dividend per share. And to get that, you do need to have stable to slightly positive net profit growth. Okay, next question. Real estate crisis still persists. How does that affect the banking sector? What are the risks that investors should be aware of? I'm actually much less concerned about the real estate sector than I was, say, maybe 3-4 years ago. Now, in terms of the exposure, I think the key thing to note, let's separate out the retail side and the corporate side. The corporate side is primarily property developers. Now, property developers, actually the exposure isn't that big. You can see even at the peak on the top left over here, even at the peak, the exposure on average for the sector maxed out at about 6.2%. Right now, it's come down to 5%. So it's not really that significant in the scheme of things. Now, you might ask, why is it so low? It's so low because the regulator, way back in 2015, 2016, it was actually thinking that, okay, this property in mainland China, property developers are taking on too much leverage, property prices are too high. If later on we want to do something to the property sector, we don't want our banks to have too much exposure. So it told the banks, he said, guys, I know that you're saying that property prices never fall. I know that you're saying that property historically hasn't had any defaults, but control your exposure to the property developers. So the property developers then had to go to Hong Kong, raise US dollar bonds. They had to go to shadow banking trusts, companies, and so on to raise finance. And the consequence of that is that when property started to actually suffer, these banks didn't have much exposure to the property developers. It was the US bondholders in Hong Kong. It was the shadow banking sector in mainland China. So I'm less concerned about the corporate side of the real estate. On the retail side, it's primarily mortgages. And mortgages, yes, your NPL ratios are ticking up, but heck, it's going up from 0.3% to 0.5%. It doesn't really move the needle that much. Plus, if I take a look at across the Asia Pacific region, I don't think there has been any crisis in terms of mortgage write-offs. Even if we go back to I think the Asian financial crisis, because of the relatively low loan to valuation ratios, the supposedly high quality collateral of residential property, the eventual loss rates of these banks on mortgages tend to be very low. It's not like US, whereby in US you can actually default on your mortgage and the rest of your property is affected. Asia is not like that. So not that concerned about the real estate exposure of the China banks. Okay, compare HSBC to the China banks. Now, this is a bit interesting because China banks, there's no net profit growth. China banks has been a much greater beneficiary of southbound flow. China banks' story is all about, the insurers by the southbound investors coming in to buy these shares, and then because the dividend yield spread against the China bond yields are still attractive, hence the share prices can continue to rally until the dividend yields fall down to a level whereby the insurers might decide to buy fixed income instead of China banks for the dividends. HSBC, other than Ping An at one stage, there hasn't been much interest from the China insurers to buy HSBC. So HSBC is much more, share price wise, it's much more driven by underlying fundamentals. HSBC, you actually need to analyze, what's the NIM trend, what's the buybacks, the capital management, because these are what the international investors focus on. And international investors, much more so than the southbound investors, have been driving the share price of HSBC. Now, HSBC, in terms of the outlook, yes, you have challenges from the very low HIBOR, which hurts the net interest margins. But on the other side of the equation, you're benefiting a lot from strong wealth management flows from the mainland to Hong Kong, from the mainland to Singapore. I think you can see that in the case of the Singapore banks as well. So HSBC, I think, is more a story that, just now one investor actually asked me about sustainability, and I can throw in quality of management over there. People will actually say that HSBC has good management quality. People might struggle to actually say the same thing about the China banks because they have a perception that the first priority of the China banks may not be the international investor, but maybe the Communist Party. So it's more like a different focus as such. But generally, HSBC, I think, is a company that a lot of global investors feel comfortable holding for the longer term. Okay, last question. Do you see the possibility of Southbound investors to withdraw the investment to mainland? So I assume over here you're talking about a reversal of the southbound investor flow. And yes, I think that is the possibility. I think that's one of the reasons why you then need to distinguish between the type of southbound investors. Now, what we have over here on the top left is we've tried to segment out the entire southbound investor flow, not only look those investing in banks, but those investing in other sectors such as new economy like Tencent, Alibaba, Xiaomi, Baidu, and so on. You can see that the dark blue line over here is the southbound investors that invest in the China banks, very stable across time. The red line is the one that's volatile. And the red line is the one that I would say, and that's a new economy line, by the way, that's the hot money flow. The hot money flow chasing after the whatever is performing quite well at that point of time, which at that point of time, early this year was DeepSeek related themes, new economy rallying, or in September of last year when you had those stimulus measures come out. And that I agree can be volatile. And that I agree could flow back to mainland if mainland goes into a big bull market and from a momentum trading point of view, they find buying A shares more attractive than buying H shares. So that portion of the southbound investor flow could reverse. But in the case of the more stable dark blue line, the China banks, what you then need to take a look at is, the AH spreads. Don't forget the H share China banks trade still at a notable discount, I think of about 20 to 30% against the A share. So it still makes sense to buy H share banks as well as vis-a-vis the bond yields. So I think the insurance flow can still continue. The southbound investor flow into the banks can still be more resilient compared to the other sectors.
Okay. All right. Thank you, Michael. Thank you, everyone. I think we want to thank Michael for spending the time. I think you spent about 30 minutes to answer a lot of the questions from the participants. We really appreciate that. Right, guys, if you have any other questions or anything, feel free to just send in an email to our retail services team and they will reply you promptly. Thank you, everyone. Thank you, Michael. Appreciate it.
Okay, thanks a lot. Good night.
Okay, good night. Bye.